Welcome. So today, what I would like to share with you is this plot. The nominal interest rates across a number of major currencies are currently negative. Okay, so you have the Swiss franc, euro, and Japanese yen. They start to dip into negative territory. So what motivated me to start exploring the implication of negative interest rates is this is uncharted territory. In terms of academics speaking, the principle of no arbitrage is a foundation of investment theories. Okay, what is a principle of no arbitrage? Basically, arbitrage means you can make safe profit without your own money. In an efficient market, that shouldn't exist. And that helps decide the pricing of a lot of portfolios. So when the interest rate is negative, it's an arbitrage. Why? If a nominal interest rate is negative 1% per year, how can you profit? You borrow $100 for a year, you tuck the $100 under your mattress, 1 year later you repay $99, you get $1 profit. For sure, without using your own money. That's an arbitrage. Okay? Why is arbitrage important? Because that helps pin down the price of a number of portfolios. So for example, if an apple costs $1, a banana costs $2, what's the fruit basket price? That consists of 1 apple and 1 banana should be $3. Okay? Otherwise, you have a profit opportunities. Now, this fruit basket could be a portfolio of stocks. It could be an asset-backed security, et cetera, in financial market. So the principle of no arbitrage pins down a number of portfolio prices, which is very important. But when the interest rate is negative, the nominal interest rate is negative, that gets violated. Okay? So that makes me a little bit uneasy. Because why? If let's say you believe Newton's physics and you build a spaceship, and then later on you declare that the gravity, which is assumed in Newton's physics, doesn't hold anymore, will the spaceship fly? Maybe, I'm not so sure. Maybe there's subtle ways that the spaceship depends on the gravity, yeah? Just like the principle of no arbitrage here. Maybe there's a subtle ways that the financial markets depend on that. So that kind of got me started thinking, what would be the implication of the negative interest rates, nominal interest rates? And then another problem is we have little experience with how things work when interest rate is negative. Right? So if you want to quantify things for policy purposes or form an optimal portfolio, you have no data, very little data. Now, that's the two problems. So I'm going to study in this framework. I'm going to set up a fairly quantitative framework just so you get a reference if you want to dig deeper. But most of the talk, I'll discuss the implications from that. Okay? So in this framework, I'll study an investor who chooses a portfolio to maximize his lifetime happiness. Now, we academics call that happiness utility functions. Okay? So in particular, this guy, I assume, has an investment horizon of capital T. So each period, this guy gets to consume, okay, and he derives a happiness called a U that depends on this consumption. If this guy gets a good French wine, C goes up, U goes up. Yeah? So that's, and then you sum up the T period utility, that's his overall happiness across a T period horizon. And the goal is to maximize that. To keep things simple, solvable, I assume there are two investment opportunities here. One is the nominal risk-free rate, okay, short-term risk-free rate. This R could be positive, it could be negative, and at the end of the model, I'll vary this R from positive to negative and see what happens. And then assume there's a risky investment. Eventually, when I show you numbers, I'll plug in some expected return alpha, volatility, sigma every period. Okay, so let me spend a few minutes on the utility function. Okay, I will demonstrate this utility function using log utility. Okay, so the first example is your happiness deriving from your consumption is just the log of your consumption. That's a blue line here in the plot. Blue line in the plot, okay? It's increasing function, meaning if you consume more wines, as long as you're not totally intoxicated, your utility goes up. If you get a good yacht, maybe it goes up even further. So it's an increasing function, okay? Now what's the log, what is log 0? When consumption is 0. What is log of 0? It's negative infinity. Okay? So meaning when you have no consumption, the utility is so negative, it's negative infinity. This is to capture the fact that you need some consumption to keep alive, right? If you have nothing, you can't eat, you die. That's negative infinity. Okay, so that's what is being captured here. Now another utility function is otherwise the same, but you minus a number. For example, h is 1 in this plot. So in that case, if h equal 1 in this yellow plot, and if you have a consumption of 1, log of 1 minus 1 is log 0. That's again negative infinity. So this setup captures the fact that you need at least $1 to keep you alive. This could be a food expenditure, rent, okay? This people call that subsistence level, or you can call that habit, okay? So I'm gonna talk about these two utility functions, okay? It turns out they make a huge difference in how you think about the policy implications of negative interest rate, okay? Now if you wanna go fancy, log utility is a member of CARA utility, constant relative risk aversion, just in case you want to know. Okay. And then once you set up this optimization problem, you just solve it. Okay. I present this framework just so that later on, if you want to solve the exact portfolio weights, okay, you know where to start. The exact method to solve them is a bit technical. Sometimes it's discussed in good graduate programs. I'll skip the details, but if you're interested to solve them now, these are two classic references. One is by Merton in the 70s for a more simpler setup. And then Jun Liu, someone who I admire a lot, is technically superior, solved this optimization problem, optimal portfolio, for a much more realistic setup when you have many, many assets to solve, things like that. Okay? So this is the solution. Okay? So the first plot, horizontal axis, is the nominal interest rate. It goes from positive to 0 to negative, okay? The vertical axis is how much money you allocate to the risky investment. The risky investment here I parameterize to be having an annual average return of 5%, volatility of 15%. It kind of matches the major world stock indices, okay? I hold the expected return the same, okay? Even though when the interest rate is lower, just to give kind of the policy more likely to work, okay? But anyway, don't worry about that. And then this vertical axis is how much money you allocate to risk-free asset. Think of that as bank deposit, okay? When this number goes negative, it means you borrow money to invest in a risky investment. Okay? Horizontal axis is a policy variable, nominal interest rate. Guess what? The implication is that if you think about the policy goal of stimulating investment by lowering interest rate, our past experience under positive interest rate scenario carries through to the negative area. When you lower interest rates, people invest more and more in the risky investments. Why? It's kind of intuitive because I have assumed the stock return is 5% per year. When the nominal interest rate gets lowered to 0, you allocate more to the risky investment, which is more and more attractive now. Yeah? And in fact, it could be so attractive that in this setup, in this example I worked out, people borrow money to invest, so which is good. This works only for this log utility. Okay? Now let me show you a picture. When the utility is, you just make a tiny change to that. You add -1 to it, log. So that this here, we're assuming that you have a minimum subsistence level of H. Without that, for example, you starve, for example, okay? Then something quite striking happens, okay? When the nominal interest rate is positive, central bank lowers rate, same thing happens. People borrow from their bank account, borrow from bank, invest in risky asset. But when you cross into negative territory, things change very quickly. Risky investment goes down. People don't borrow so much to fund risky investment. In fact, if you push the negative rate sufficiently negative, you actually have people dumping risky investments and holding cash in the bank. Okay, so why? What happened there? So this is the intuition. Okay, let's say you start out with $100. This could be $100, could be 100 million, if you're managing a bigger pension fund. If you have $100 and you want to make sure that you have at least $60, okay? After 10 years, let's say $60 is your subsistence level. This is your rent payment, food expenses. Now for some people, a yacht club membership may also be considered a subsistence level. But anyway, you can put whatever you want there. When the interest rate is zero, okay, zero. If you want to guarantee a $60 expenditure, what do? You put $60 in the bank, earning you zero interest rate. Yeah, it's low, but you guarantee the $60 for your food expenditure. You have $40 left that you can take whatever risk you want. Okay, if the Federal Reserve or European Central Bank, lowers interest rates, that makes risky investment more attractive, you can allocate more of this $40 into the risky investment. Okay, so that's the policy goal of stimulating investment. That works right there. When you lower this interest rate to negative, in this example, let's say you lower it to negative 5%. Now, if this pension fund allocates, let's say, $100 million entirely into the safe bank deposit, how much can this pension fund guarantee its retirees? The retirees needs at least 60 million, okay? Now, you're earning negative 5% every year. 10 years later, if you do the math, it's approximately 60, okay? Meaning, if you put all your 100 million into the bank deposit, you have barely enough to guarantee the subsistence level. Then where is the money coming from if you want to do risky investment, no matter how attractive the risky investment is? Right now, you're so risk averse that if you put all your money in safe asset, you can only guarantee bare minimum living standard. Okay? So therefore, this effect that you saw on the previous slide, people cutting down risky investment, adding risk-free asset investment, works through a wealth effect. When you're cutting the nominal interest rate to negative, guys who have a minimum living standard requirement and who have a long horizon, 10 years here, is to have their perceived nominal wealth very, very close to their subsistence level. This makes them very, very risk averse. So they won't take on risky projects. Okay? From this quick example, you can see this effect is bigger for long-term investors. If you put an investor with 30-year horizon here, just imagine how much negative 1% would do. Okay? So I just showed you two utility functions. One with a subsistence level of 0, everything is happy. One is a subsistence level positive. Which one holds? Academics have done studies. So if you're interested, this is a reference. People actually find with positive subsistence level, you actually capture stock market behavior better than 0 subsistence level. It's also kind of intuitive. Right? We all need something to keep us alive. Okay? So then, why did the lowering interest rate kind of work when the rate was positive instead of negative? Now, if the rate is positive, and let's say European investors, Japanese investors, these were advanced economies, they start out have enough wealth to stay above their subsistence level. If you make the nominal interest rate less positive but closer to 0, as long as it's not negative, these guys will still stay above their subsistence level, no problem. Now, once you have rate kicking in negative, you actually make people getting closer to their minimum subsistence level. For some guy with 30-year horizon, even a negative 1% make this person perceive himself as 30% worse off at the end of the 30-year horizon. Okay, that could make this person very, very much closer to the minimum living standard. Okay? So is this all doom and gloom? Is this all bad? Actually, if you dig deeper into the analysis, there may be a way to help. It's a wealth effect, right? It makes people perceive them to be worse off when the rate is negative. So it can actually be mitigated if the low rate or negative rate kicks up a bubble. If it kicks up a bubble, in our early example, if I have $100, interest rate is negative, you only have $60. If you need $60, you can't take any other risk. But if you kick up a bubble somewhere, let's say that makes this guy having $200 instead of $100. Then you do the calculation. Now he has some extra cash to take risk somewhere. It's a bubble problems. Some people say, we got into trouble because some historical big bubbles. But on the other hand, just one way to show that, bubble could have, in this scenario, helpful effect to accomplish some policy goals. Okay. So now let's apply this. So for which country will negative rate not work? Not work meaning not accomplishing the policy goal of stimulating investment. As we highlighted earlier, if this country starts out to be close to subsistence level, maybe this effect is stronger. So you are less likely to see a stimulative effect on investment from negative rates. This could apply differently across, for example, countries in the Eurozone. If you lower the interest rates, some countries, maybe after some historical reasons, maybe closer to subsistence level. So therefore, it's less likely to work for those countries. And ironically, those are probably the countries that the negative rate is designed to help. But probably no, according to this analysis, at least from this perspective, negative rate actually more likely to help those countries in the bloc that's further away from the subsistence level. Okay? Now, it's not likely to work if you have a country dominated by long-term investors. For example, in Japan pension fund is very powerful. Right? They made news a while ago with the reallocation of the portfolios. Right? If you have long horizon investor, you push into negative territory, we just show you, it could have a big effect, big wealth effect because the horizon is long. So it may be less likely to work there. And across Shenzhen border, anecdotes suggest in Chinese stock market, it's dominated by retail traders who get in and out. They have a short horizon. So in fact, interestingly, this short horizon might actually imply this effect is less strong for the mainland stock market. So negative rate, if it shows up there, maybe is more likely to stimulate investment. Okay? And also, bubble might have an effect. So which country will the negative rate likely work? It's just exactly the opposite. Okay? So in conclusion, I think I shared with you my view on the negative rate. I'm somewhat concerned. Some of the concern showed up in this model analysis, but some other concern is maybe there's some unknown, right? If you take away an important building block of modern portfolio theory, the principle of no arbitrage, now introduce something with arbitrage, the fantastic question earlier just illustrated some traditional optimal portfolio problem now all of a sudden have two solutions instead of one unique solution that historically people have shown. Okay? I hope I'm wrong. Okay? I hope the policy work. But I think some of the plot you saw earlier shows that negative rate environment might be a paradigm shift from the positive rate environment. So historical data, historical effect from lowering rate may or may not work when you move into the negative rate territory. So that's all I have to share. Thank you very much for the comments.